Welcome to BNEWS Weekly Special Report. I'm Phil Gallagher, along with my guest, who I'd like to welcome, William Boivin. Welcome to the show, Bill.
Thank you very much for having me today.
Bill is a member of the Vote Yes CPA for Burlington, and we're going to talk about what the CPA is, what the components of it are, and what should happen on the ballot in November. It's question 5, I believe,
That's
on
correct.
the ballot. Okay, let's start right away with just give us a general overview of what the CPA is, the Community Preservation Act.
That's exactly right. The CPA is basically what the name implies. It's an act, a law instituted 20 years ago by then Governor Cellucci, signed it into law. And it is to preserve the community, not the police and the fire and the DPW and the retirement fees and all that kind of stuff in the schools, but the factors that make a community, the other items such as open space, recreation, historical preservation, affordable housing. We have areas in those topics in Burlington that make us Burlington.
Mm-hmm.
You know, we have Mary Cummings Park, we have the landlocked forest, we have Vine Brook, we've got a number of playgrounds and sports fields and things like that. We have the Francis Wyman House and the town museum, and over 100 homes in Burlington that are over 100 years old. 3 dozen of them recognized as of historical significance. And one of the things that attracts people to a community is the affordability of living there. So affordable housing is a big issue as well, in helping to define what makes Burlington, Burlington. And that's what the Act is all about, helping people preserve that.
Okay, how does it work? It's essentially a tax increase.
It is a tax increase. The first thing I want to make perfectly clear is that the ballot says 1.5%. That is not a 1.5% increase on your property value. It is a 1.5% increase on your property tax. The Burlington tax rate is, for residential, is almost exactly 1%. This would make that 1.015%. It's a very small increase for the vast majority of residential taxpayers. That would be $20 to $25 increase on your quarterly bill, which is typically $6,000, $7,000, $8,000 per year. So, a quarter of that. So it is a small increase towards these programs.
But if you're paying $7,000 in taxes, it would be $105. If you're paying $10,000 in taxes, it would be $150, right?
Correct.
So it's essentially 1%.
Minus that $100,000 deduction, which I'm sure
$100,000, we'll
into
talk about
exemption.
that. Also, who is exempt from it, or what opt-outs can be done. That's part of the program.
Okay.
So it's collected on an annual basis, and it's dedicated, it's earmarked essentially for how many buckets?
There will be 4 buckets, and it's collected quarterly. It's collected with each quarterly tax bill. The 4 buckets are: 1 for open space and recreation, that's combined in one pot by the law; 1 for affordable housing, and 1 for historical preservation. Each of those are mandated to get at least 10% of the money collected each year.
Okay, so it's
And then
you
the
said
fourth
open
one,
space. Oh, the
Yep.
fourth one. Okay, I'm
okay,
sorry.
so those 3 are 10% apiece.
Right.
The 4th one is a general pot,
Okay.
in which the other 70% goes into, and that can be spent on any of those program areas depending upon the project submitted. There is one caveat in that you are allowed to have some administrative expenses up to 5%.
5% of the total value of the expenditure
Of the total value of the money in the pot.
on an annual basis?
Yes.
Okay. So right now, that would generate how much, based on your projections, if it passed, what would that generate from both commercial and residential properties in terms of income from the town side?
Okay. I did the calculations based on 2021 data that I got from the town assessor.
Right.
The average property values, the total monies collected, et cetera, on property taxes. And it turns out that if we were in it in 2021, would have had 600,000, these are round numbers, 600,000 from the residential sector, $1 million from the commercial sector, and an additional 600,000 match by the state.
Okay, that's the sweetener, is the
Yes, it
matching
is.
from the state.
Yes, it is.
Okay. Where does the state revenue, what fund, that's a preservation trust, where does that money come from?
The Community Preservation Trust Fund was established by the state to fund this matching. It comes from fees on real estate transactions in every community in the Commonwealth. And it's a number of different things. It's not just purchases and sales of properties, but it's refinancing. It's anything that's filed with the Registry of Deeds. It could be a certificate of operating conditions from the Conservation Commission. It could be a variance for your setback of your shed. All those things are filed with the Registry of Deeds. All those have a $50 fine, a $50 fee attached to it. Those add up because it's every community. Burlington's been paying those fees since this was implemented in 2000.
So for 20 years, we've been paying, who's ever going down to the Registry of Deeds from Burlington is paying those fees.
Correct, and that money's going to all the existing CPA communities.
Okay, how many existing, there's 351 cities and towns in Burlington, in Massachusetts.
Yes.
How many of them are participating in the program?
Right now, there's 189 actively in the Community Preservation Act. There are 6 more who are on the ballot in November, one of which is Burlington.
Now, how much is guaranteed, if any, is coming out of that trust to the member communities?
Each year, the money that is in the trust fund must be spent and put out to the communities with a very small amount retained to keep their funds open.
Okay, so they dissolve the entire balance into the
Virtually,
member community?
yes, they do. 80% of all that money gets distributed to all of the communities and proportionately to how much money you have in your local fund. So we had, in that first example, 1,600,000. They look at that and they say, they add it all up, they take their money, divide it by all that, and they say, well, you get 42% or whatever it was. So that's where the money comes from.
Okay, so this is a fair distribution of money, none of this equity stuff for poorer communities or richer communities?
Well, there is
If
one,
your share...
you notice I said 80% was distributed that way.
Okay.
There is an additional 20% that is distributed only to those communities that elect to have a full 3%, the maximum allowed by the CPA legislation.
I see.
We could have had 3%, we could have had 1%, we elected 1.5% because that's a common theme.
Right.
The majority, the highest number in all those 189 communities is 3%.
Yeah.
Most communities elect for that.
And are they the richer communities? So this is a non-equity type distribution, huh?
Well, no, it is actually equity because it's only those communities that are allowed to get this extra second distribution. 10% of it goes to the second distribution, but there's the 10% of it goes in equity distribution depending on the population of the community and the average real estate value per person in that community. Those two items rank each community into one of 10 deciles, they call it. And so then that money is distributed proportionately with the smaller communities getting a bigger chunk. But they also had to have committed to 3% to qualify.
For that extra money?
Right, right.
Okay, so where does the money go that we collect? Is it distributed to a treasury account of our own under the treasurer's auspices, or does the state hold that money? No,
it's all held locally. It's all spent locally. There is the town treasurer would have the responsibility of setting up those accounts and managing the money.
Okay. Now, who is, you talked about a $100,000 exemption. Talk about that first, and then who else is available to opt out of this thing?
Okay, the law is very specific. It allows certain exemptions in who has to pay money and how much. We are opting for all of the exemptions that we can. The first exemption is the first $100,000 of property value is exempt. Right. If you have a $700,000 house, your 1.5% surtax that we're talking about is only on $600,000 because $100,000 is exempt. Right. That exemption also applies to commercial property. Now, big companies, that's not much.
Now, again,
Small
it's not on the
companies,
value, it's on the taxation, right? So 1% of a $600,000 house would be a lot more money. So it's on the taxation,
right,
not on the value.
Right. We look at the real estate tax on that $600,000 portion. It's 1.5% of that.
Right.
So
in that case, it would be $90, right?
Correct.
Okay.
Correct. So nobody actually pays 1.5% because everybody gets some kind of a $100,000 deduction.
Right.
A bigger house might pay slightly under that.
Mm.
A small house valued at $400,000 would have a quarter of its property value exempted from this tax.
Right.
So there's that $100,000 deduction on all properties. The other thing that's allowed is,
So just a
Yeah.
moment.
yes,
Based on that, suppose I'm paying $90. I would be paying in $90 and getting essentially a 60% return from the state on that, which would be 70. So I pay 90, I get $152 back paid into the town, right?
you can look at it that way,
Okay.
but you can also look at it that you pay 90 and you're getting 200 from the commercial and $60 from the state.
Right.
You know, so
right,
you're getting, if you're just looking at the residential,
right.
when you add in those, there's a significant, you know, return on your
But the
investment.
return on the 90, whichever way you look at it, is pretty good.
Yes, exactly. The guarantees, it's guaranteed that that money is paid out every year. It's varied over the years. It started out at 100% because there were so few communities in it, and yet all communities were paying
Right.
those fees. And it went down over the years quite a bit. It went down into the 20s at some point, maybe even 19% one year. And that's mainly because more communities joined, but also the fees stayed at $25 per transaction for 18 years or 19 years. They never changed.
Mhm.
So Governor Baker and the Congress changed those fees from 25 to 50, which immediately doubled the percentage from the 20% range up to the 40% range. So now it's at $50 and we're getting the 40%.
Now, who else gets, it can opt out, or there are income provisions?
That's correct.
Single married
Yes.
couples, et cetera. What are those provisions?
There are two exemptions income-based. The first one is for low-income families. And there's a chart that's available on the what's called the CPC, the Community Preservation Coalition. That's a statewide organization that oversees and helps all the communities. They have a chart in there which shows you what it is. It's all based on state definitions.
I think
Of
it's on the
low-income
Burlington
family.
website too, isn't it?
It is on our website.
And
There's a
that-
link
the
to it.
Burlington link is CPA yes Burlington?
Yes, cpaburlington.org.
Yes, cpaburlington.org if you want to look at those income limits.
Thank you. So I can tell you what they are, just two examples.
Okay, sure.
For a two-person family, if you make $89,728 or less in household income, you can completely opt out of paying this.
Okay, and that's AGI, that's adjusted gross income after all of your deductions.
Correct,
Okay.
as it would appear on your income tax form. For a senior family, 60 years or older, if the head of the house is a senior, a two-member family there, 112,000 or less would qualify. That's a moderate income seniors, low income for any age. So those levels can opt out, and you opt out the same way you would in any income-based exemption in town. You have to prove your income to the town assessor's office, and then you're eligible to opt out.
Okay, and anybody else in any other income category cannot opt out?
That's correct.
Okay. So what is the process in terms of spending the money? Who makes the applications? Does the town do it? Is it special interest groups that do it? What is the process by which proposals are accepted and voted on and approved?
Okay. If this passes on November 5th
Well-
or November 8th, the first step that would have to be done is a bylaw would have to be written to form a local community preservation committee.
Okay.
That committee their purpose is to collect all of the proposals, evaluate them. They're also required to do an annual needs assessment and discuss with the town, with town meeting, with conservation and affordable housing, everybody, and try to get a good handle on what the needs of the community are, so that when these proposals come in, that committee can rank those proposals in their priority. It can assess whether they're even eligible under the program first. And then they submit all of those to town meeting. Each and every proposal still must be approved by town meeting.
Would be an individual warrant article.
It depends. Some communities put in one warrant article saying, here's 10 items on the CPA,
Okay.
and they get passed all together. Other ones, and of course you could say no on, I want to
Right.
put in amend it,
et
et cetera.
cetera.
I think it would be wise to do them one at a time.
Yeah.
Who can submit proposals? Anybody.
Mhm.
You or I can, the school can, a church can, a business can, the town departments can. Conservation could put in a proposal. Anybody can put in a proposal to be considered.
Right. So it's a regular appropriation process.
Yes, in that sense it is. Some communities have a two-step approval process. Rather than having to put in the full, formal, complicated application, they have an informal, you put in your idea and what you think it's going to cost, and the committee looks at that and approves it. And if they say, yes, we're willing to submit this, now please submit the full formal application. So
Now,
that
who
makes it a little easier.
what does this committee consist of? Is this, and who appoints them, or what does the membership consist of?
That's to be defined in this bylaw.
Mhm.
There is certain requirements in the act. You are required to have 5 specific members, one each from the Conservation Commission, the Recreation Commission, the Historical Commission, the Affordable Housing Authority, and the Planning Board. So those 5 members are mandatory. Those members are selected by those boards. Conservation decides
Appointed by the chairman,
amongst
sure.
themselves who wants to be that representative. The law allows for up to 4 other optional members, and that's what has to be defined in the bylaw.
Mhm.
If we say there'll be 4 optional members, we have to say in the bylaw who gets to appoint them. It can be, you know, the moderator, it could be the selectman, it could be a combination. I've seen some communities say the selectman and the moderator collectively vote, and it has to be a majority of that group or whatever. So that is yet to be defined, and that bylaw will have to be approved by town meeting as well.
As well. Now, that would be a standard majority vote, not a 2/3 vote, but that's another matter.
Yep.
Now, on the funds themselves, if we're talking about that would be almost $400,000 annually that would be contributed to these funds. Each of the four funds. 1.6 million spread out over 4 funds?
No, 10% goes into the first 3.
Okay, 10%, okay, all right.
So
So can the funds accumulate, or do they have to be dispersed on an annual basis? What goes on with the funding?
the funds start accumulating. If this passes, it'll become effective next fiscal year, July 1st, 2023.
Okay.
At that point in time, with each real estate quarterly bill that goes out, this surtax will be applied and the money will start going into the pots. If at that time, we also have a committee defined, with the committee and money, you can start accepting proposals and spending it, even before you get a state match. We wouldn't get a state match until the end of that first fiscal year, when they
To
look at how
determine
much was
you've
put in.
collected. Sure,
Correct, and then
sure.
you'd get the state
That
match.
makes sense.
So it can be starting to be funded at that point.
Right. Now, suppose this thing doesn't work out, people don't like it, how do you get out of it?
There is a community opt-out process. Once you've been in it for 5 years, they want to make sure that you've given it a good, fair test. At that point, you can opt out the same way you opted in. You have to have
Townwide
town
ballot.
meeting, say, let's put it on the ballot, and it goes up to the ballot to opt out. In the 189 communities that currently exist, I think there were 5 or less who did put it on the ballot, and it was voted down to opt out. They did not want to opt out. So 189 have never opted out. If anything, there was probably 10 to 15, I wish I had the exact numbers, who opted to increase the percentage. Because that, again, through the same process, you can change it to be from 1%, 1.5% to 2 or 3. And a number of them increased the percentage to 3 because they liked the program and they wanted to get that extra 20% bonus at the end of the matching.
Right. Now, I brought along the 10-year capital plan and the
Sure.
10-year previous spending by the town. There's a couple of things here. First of all, let me preface my remarks by saying the state is rolling in money. They get a $5 billion surplus, so much money they have to rebate $3 billion to us.
Which is rare.
The town is rolling in money. We've got probably upwards of $40 million between free cash, stabilization, OPEB, et cetera. Now, one of the problems here is if we look at the buckets that we've talked about, if we look at the expenditures, virtually none of these items are on the 10-year capital spending plan as priorities. I think this year we spent $33,000 for a shed at the West School. We have spent, we all have always spent money on recreation. This year, I think with the Marshall Simons Trust, we did the basketball courts. We're also doing the log cabin, which I think is partially funded or fully funded by them. We've done $1 million, over $1 million on the school football field, which is essentially recreation.
Mm-hmm.
We've spent virtually nothing on affordable housing over the years because we've gaffed the developers for their portion of the large developments that we've granted them.
Right, right.
So that hasn't cost us anything. And historically speaking, what's left? The Union School is I went to 6th grade there, as I've told the viewers many times on occasion. In all likelihood, that's going to be knocked down for a new police station. So it really doesn't leave much money to be spent on historical items. So are we going to have a competition here by people who have special interest to access really what is going to be a large pot of money?
I don't think it'll be special interest driven at all. It isn't in other communities.
Mm-hmm.
It's local people putting in proposals for local use. One of the ways I look at it is it's like an IRA or a 401k. The best time to be investing for the future is now. You know, when's the best time to plant a tree? 20 years ago. What's the second best time today? When's the best time to join the CPA? 20 years ago would have been best because we'd have all that experience and money and matching. But the second best time is today. So you start by saving for your future in small, regular, incremental inputs, which is what this sets up, your quarterly tax bill in small amounts. So saving for the future, I mean, you don't have to spend all this money every year. You can let it ride, you can let it build, you know, affordable housing part could let that 200 grand a year build for 5 years and then invest $1 million in a property to completely renovate it into affordable housing.
Right.
And so it's an opportunity to invest in the future is what it is, the way I look at it.
Mm-hmm.
And the best time to do that is when you have the money to do it.
Right.
And you see some communities that have had incidents come up where they were really glad they had the CPA, unexpected things. For example, a number of communities, when COVID hit and the pandemic shut down work, people who couldn't work couldn't pay their rent and were facing eviction with no place to go and no income. And the affordable housing component of the CPA was allowed to pay for rental assistance. Totally unplanned when they started saving, but it turned to be a valuable asset when it came up.
Mm-hmm.
I'm looking at the newspaper today in Situate. They had a historical lighthouse where all of a sudden the building department looked at it and said it's unsafe. They were able to use CPA money to pull the top off of it and go fix it and going to put it back. That uses CPA money. Without CPA money, they may have completely lost that structure. They may have not been able to put the top back on and completely deface that structure or whatever. So planning for the future is an important aspect, I think, of the CPA. I think when the proposals start coming in, you're going to see some creative proposals for areas that people don't normally put into the normal process because they think it's too big or they think it won't get approved in the normal process. So it's going to be a different revenue stream and a different approval process that I think will be interesting.
Let me split hairs and be devil's advocate
Please.
here. As I mentioned, the capital plan, over the next 10 years, we're looking at upwards of $150 to $200 million in priority spending. I could name them all: PFAS, Fox Hill School, boilers at the middle school, the high school,
Sure.
et cetera, MWRA hookups. We pay that out of the tax levy. Now this is going to automatically be, and these have been very ripe years the last couple of years. Taxes have been high, tax increases have been relatively low, but this would be an automatic 1.5% increase right on the top of the levy. So for instance, this year we had a 5 1/4, I think. Correct me if that's wrong, I'm sure somebody will. We had a 5 1/4 levy. This would make it a 675 levy. And again, these are good years. We had, you know, our collective bargaining units have been very reasonable over the last 10 years. Now we're looking at 8.5%, 9.5% inflation. The bargaining unit's certainly not going to settle for 3% 3 years from now if you have 8 or 9% inflation. So you have that component, which is over 90% of our overall budget, which is going to mean extra high levies. If you go back to the Carter years, we had some of the contracts with 3/7s, I think, 3/6, 6/6, and 6 on all the bargaining units.
Mhm.
So we would essentially be taking that 1.5% out of the levy to pay for these priorities and putting it over into these buckets, as you say. Is that prudent financial planning in your mind for the future?
Well, we're not taking it out of the levy. We're augmenting the levy with it. You're not allowed to replace existing funds.
No, I
With funds
understand, but if
from
the
this
levy
fee.
is 5%, you're automatically making it
You are,
6.5%
yes, you are.
with the additional 1.5.
Part of what you said answers your own question in that expenses are going to go up. The economy is not looking that good. You are going to be asking for higher percentage increases in the future for some of your contracts and things of that nature. That's going to put more of a burden on the standard budgeting process. So having this pool that is guaranteed and stable will allow continued funding for these areas that are important to the character of our community and the quality of life that would probably suffer in the future when these other expenses start to dominate more than they are now.
Mm-hmm. Okay, so let's talk about the community at large. You've been working like a dog, if I can use that example.
Hey, some of my best friends are dogs.
Me too. You've been at the Ways and Means, you've been at town meeting, you've been on the air, you've been at every single group that you could possibly find. I hope the Girl Scouts haven't been.
Not yet. Not yet. We didn't think of that.
So tell me, what kind of a reception are you getting in the community at this point?
It has been, I would say, overwhelmingly positive.
Mm-hmm.
People come up to us and when you explain, a lot of them don't know what it is, you know, so that's important. We don't have a newspaper anymore. We don't have, this is a great way to get some of the news out here. But a lot of people are not familiar with what's going on. So our first role is to educate people as to what's going on, pro or con, so they can make an intelligent decision. We want them to make an informed decision on the ballot. And when we explain to people what it is, or they've already heard about it and understand it, they really say, we like this. The things I hear the most about are affordable housing for seniors, there's no place to relocate, there's no place for my kids who grew up here to buy a single family starter house, things like that. The biggest thing we hear is recreational areas. Complaints like the soccer fields are mud pits in the spring, and we heard at town meeting, the playing field, the athletic fields, the boys' athletic fields have scoreboards and the girls don't, and things like this that people would like to see corrected. There was a study done on athletic field needs funded by town meeting. That's going to come back with millions of dollars worth of stuff that should be done, and they're not going to do it all, with a regular budget, especially if things get worse. A biggie is restrooms at playgrounds, and I looked at the data. That coalition website has a complete list of every project that's ever been funded under CPA, and you can search and sort. I put in restrooms and bathrooms. There were over 60 of them funded in playgrounds.
Okay, I've only got a minute. Tell me what you're doing coming up to the election to move this proposal forward.
Okay, one thing I definitely want to say in the last minute, and that is there was a town mailing sent out recently with a pro and a con statement.
Just got it, yeah.
In my opinion, the con statement is somewhat misleading. It says specifically that CPA restricts spending on existing parks in the landlocked forest. It is true for the landlocked forest in a park like Mary Cummings Park, but that is not true for recreational facilities, playgrounds, etc. CPA money can be spent on existing playgrounds and existing athletic fields. Originally, when it was written, it couldn't, but they did an amendment in 2012.
Well, Cummings and the landlocked land have prohibitions anyway unto themselves. So
correct.
That has nothing to do with CPA, really.
We couldn't do anything there in
Yeah,
terms of capital
really,
improvements.
Really.
But we can do capital improvements to existing recreational
Right.
facilities. So I wanted to make that clear.
Okay, so what's your push here in your campaign? 30 seconds.
We are hitting the streets. We're going to have yard signs. We got over 80 people signed up for yard signs already. We're putting flyers out wherever we can. We're planning a townwide mailing of a postcard to try to explain what's going on. And I would ask everybody to read that postcard and please, go to the website that's listed there for complete information and look at that list of projects that's been done.
Yes, CPA for Burlington.
Yes, cpaburlington.org.
Okay, that wraps it up. I want to thank our guest today, William Boivin, who's been a champion for this over the last 6 months to a year, actually. Bill, thank you for joining us.
Thank you for having me, Phil.
Thank you and have a pleasant evening.